The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Late last week, Jake Sullivan announced that the U.S. is preparing new sanctions on Chinese entities for their support of Russia, with Chinese banks being the primary targets. Speaking at the Aspen Security Forum in Colorado, the U.S. National Security Advisor stated, "We think China should stop because it is profoundly outside the bounds of decent conduct by nation states." He added more ominously, "You can expect to see additional sanctions measures as we watch this picture continue to evolve in the coming weeks." China has already observed the freezing and potential seizure of hundreds of billions of dollars worth of Russian assets due to Western sanctions. China, which is the second largest foreign holder of U.S. bonds, currently holds $768 billion in U.S. debt, a figure that rises to nearly $1 trillion when including Hong Kong's holdings, which China controls. This substantial holding of U.S. Treasury bonds is seen as a major vulnerability in the context of Western sanctions. As new sanctions are being prepared, it remains to be seen how China will respond. Perhaps we should ask Janet Yellen for more insights.
The more we have used sanctions, the more countries look for ways to engage in financial transactions that don't involve the dollar.
In the first quarter of this year, China sold $53.3 billion worth of U.S. treasuries, setting a quarterly record. Since then, the pace has increased, with Chinese funds unloading a record-breaking $42.6 billion worth of U.S. Treasuries, agency, and corporate bonds and equities in May alone. This selling of U.S. assets, particularly U.S. debt, increases supply, leading to a devaluation of U.S. bonds and higher interest rates. The U.S. banking system already holds hundreds of billions of dollars in unrealized losses on these devalued treasuries. And with the U.S. paying over $1.1 trillion annually in interest on the national debt, rising interest rates could pose a significant problem for the U.S. economy. If China's sale of U.S. debt drives rates higher, the Federal Reserve could intervene by buying debt to lower rates. Markets are already anticipating easier monetary policy from the Federal Reserve, possibly in the form of a rate cut at the September FOMC meeting. If new sanctions on the world's second largest economy accelerate global de-dollarization and cause treasury yields to spike, it could trigger a financial crisis, necessitating more substantial intervention from the Fed, potentially including a return to quantitative easing. This scenario would likely weaken the purchasing power of the US dollar, a development that might be welcomed by the next administration in Washington. At this point, Joe Biden has dropped out of the race, and Donald Trump, who survived a dramatic assassination attempt and famously rallied the crowd afterward, has become the frontrunner. The betting site PredictIt currently gives Trump favorable odds of becoming the next president. In a recent interview with Bloomberg Businessweek, Trump expressed concerns about a big currency problem in the U.S., noting that the dollar is too strong. He suggested that a policy aimed at weakening the dollar might be necessary to reshore U.S. manufacturing and boost exports if he returns to the White House. Trump also mentioned plans to reduce inflation, although this seems somewhat at odds with the rest of his economic agenda. If increased sanctions on China and its financial sector lead to a weaker dollar, this outcome might be considered acceptable. Elon Musk has also highlighted concerns about the U.S. dollar's future, sharing a meme on X that humorously compares the current situation to Zimbabwe's hyperinflation. This meme even includes a reference to the silver dollar, hinting that Musk might be investing in silver. Overall, a devaluation of the dollar could be bullish for silver and gold prices, especially considering what China might purchase with the proceeds from selling its US dollar-denominated assets. Last year, China was by far the largest global buyer of gold, according to data from the World Gold Council. This strategy aligns with their concerns about potential sanctions, as physical gold is an asset that cannot be seized or restricted by foreign powers. China recently paused its gold purchases in May after 18 consecutive months of acquisitions, likely due to a sharp increase in gold prices. They also refrained from buying in June. Despite this pause, gold prices have reached new highs, setting an all-time record just last week. As new sanctions and increased weaponization of the dollar make it more crucial for China to diversify its reserves, it seems inevitable that China will resume buying gold. This move, combined with selling US dollars, could push precious metal prices to new highs. The combination of potential new US sanctions on Chinese banks, China's large-scale asset sell-off, and domestic policies favoring a weaker dollar creates a scenario where the US dollar's value could significantly decline. With the Federal Reserve possibly cutting rates, the devaluation of the dollar seems imminent. Now, if you like this video, check out this next video right here.